Good morning. Hope you had a good long weekend and feeling refreshed. Lots of exciting things to talk about today, and what a fantastic quarter. S&P broke above 4,000, new record. Our market up 13% in the first quarter of 2021. So certainly looking like a better year than last year. Let's hope that it lasts until the end of the year, but we'll also cover that. Are we in a bubble? Easy to believe so, given the exponential increases we've seen in some of the sectors. Also, I'm going to try and keep today a little bit shorter, just so I can answer more questions in Q&A. So please do send your questions through, and I'll do my best to get to them. But as usual, starting with the surveys, the Sygnia fund still looking fantastic across all time frames, 1, 3, 5, 7, 10 years. And across the risk profiles, low, medium, high, and high risk, all the portfolios number 1 or number 2 in the surveys. So we're very proud of that performance, and we continue to believe in our Japanification roadmap and the way we have set the portfolios accordingly. Looking at the Signature 70 fund, you can see there number 1 over 1, 3, 7, and 10 years. Performance gap is closing slightly over 1 year. You'll see that it's down to 7.5%, but 3 years still quite a large gap, particularly for diversified portfolios. Looking within the single managers, Sygnia number 1 over 3 and 7 years, falling down to second place over 1 and 5 years. Still fantastic performance. Here it's all about fees. On the retail side, we make sure that our low fees are assisting us in staying number 1 or number 2 in the performance rankings. So let's get into the markets. Our old friend Warren Buffett reminds us that markets are not rational. Remember that the stock market is a manic depressive, he tells us, and certainly they are. Very seldom do markets sit at fair value. They either are too cheap or too expensive. And right now, with the exponential increase we've seen in markets from the March lows last year, and you can see that in the survey, if I just jump back 1 slide, or 2 slides, you can see performance there to the end of February, 21% over 1 year. Longer term, 3 years and 7 years, still single digits. But right now, performance is looking fantastic as we drop off the low performers, and March is looking even better. Phenomenal returns, but that is just coming off a very low base. So the market is looking good. Has rallied very hard, and we have to ask ourselves: are we in a bubble? And obviously, it's impossible to tell whether you're on a bubble until you have perfect 2020 hindsight vision. But bubbles do have similar characteristics. If you look at the ones we've seen in the past, they all have exponential price moves, parabolic, extreme valuations. Leverage is key. There's always leverage before a bubble. Buying with no margin, buying on margin is a key factor to a very quick unwind when things go against you, as people become forced sellers. When there's no leverage, when prices turn down, the long-term holders can hold on, and you don't have as rapid an adjustment. And of course, there's always the favorite, this time it's different rationale when it comes to what you're investing in. So if we look at some of the fantastic price moves that we've seen, the market as a whole doesn't look that expensive. Certainly not, but there definitely are sectors and regions that are. We continue to believe that the US, relative to emerging markets in Europe and Japan, is looking expensive, and we continue to underweight the US stock market compared to the rest of the world. But within certain sectors or themes, cryptocurrencies continue to rally. New highs, $58,000 a coin. It really is phenomenal, incredible performance. Cryptocurrencies up 160 times over the last 6-7 years. Innovation stocks, we've all seen Cathy Wood and her ARK funds up 6 times over the same time period. SPAC and solar energy up 3 times. European renewables up 2 times, or twice, as we should say. And a lot of that increase has happened in the last year. So there is some concern that the rapid increase over 2020 has pushed some of these these themes or sectors into dangerous price territory. And I think a lot of that has been driven by US retail investors. So if you look at the chart on the right there, you can see US retail investor trading activity up nearly 10 times over 2020, over the last year. A lot of cash checks being written and handed out to every person in the US. Just had another one with Biden's $1.9 trillion stimulus plan, cash checks of $1,600 given to each investor, or well, I suppose now investor, each US member of the population, and a lot of that finding its way into the stock market, and a lot of that chasing some of the Robin Hood stocks and some of the exciting themes. Fortunately, while this is definitely a concern, there has been a pullback in some of the performance over the first quarter of 2021, and that's been driven by the rise in US interest rates. So one of the reasons why growth stocks have done so well is the fact that we have been in a very low interest rate environment. So we believe in growth stocks. We believe that we are stuck in the Japanification world, and you need to find pockets of growth where you can. But when interest rates do cyclically rise like they are now, it leads to a rotation out of growth and into value. And the reason that happens is because of interest rates. So when interest rates are low for a very long time, you can have a lot of negative cash flows up front, and then your wind farm or solar ESG fund that's only going to generate profits in 50 years, well, that's fine because you're actually discounting that at negative rates. And so the present value is very high. But the moment that interest rates start to rise and the US yield curve starts to normalize, well, then companies that are paying dividends right now, tomorrow, the more traditional, boring companies like food retailers and alcohol producers, well, all of a sudden, those start to look more attractive because now, although they've got much lower terminal growth, they've got a lot of value right now. And so that right now portion becomes a lot more important to the present valuing, and the growth companies that have their value 50 years out, that gets discounted to almost zero over a long enough time period with interest rates that are high enough. So we have seen that rotation happen in the first quarter. And some of these charts speak to that. So you look here, the top right-hand chart, and that looks at the performance of the US 10-year bond yield, which is the middle line here in gray, and then the dotted line and the dark gray line are the value indices. You can see there how value tends to perform when interest rates are rising. And we do think that interest rates will continue to rise in the US over the rest of the year, but at a slower pace. So I think we've seen a lot of volatility and a lot of choppiness happen in the first quarter because the market was surprised by how quickly US interest rates rose. And so we are expecting them to continue to rise, but at a more steady pace. The bottom left-hand chart here breaks the market up into growth and value. Bottom line there is value. You can see their value is still looking relatively cheap compared to its own history, whereas growth is still looking quite expensive compared to its own history. Of course, interest rates are a lot lower than they were in the past, so you need to adjust that for interest rates. But value still is looking quite attractive at these levels. And the third factor here is the momentum investors. So momentum investors chase performance. When growth has been doing as well as it has over the last 3 years, well, momentum is almost fully in growth. If you look here over 2020, the middle line or middle area is growth, value is the bottom there. So momentum investors had hardly anything in value, mostly in low vol and growth. But now we're starting to see momentum investors switch out of growth and into value. So value becomes the new sector that is chased. And that's why we don't think it's time yet to rotate out of value, because it's only just starting to get the tailwinds of momentum. So overall, while value has done very well, and value has been the best performing sector this first quarter in 2021, nearly double the performance of the market, and we have value as one of our satellite investments in our global portfolio. We are holding on to that. Value is something that you don't want to invest in for the long term in a Japanification scenario. You want to look for your areas of growth. But there are times, like going through now, 2021, where you need to mitigate risk, where you need to balance the styles within your portfolio. And that's why we have, for the last 4 months, had an allocation to value. And that's why we will continue to hold it tactically, not forever, but tactically, probably for another month or two, while interest rates continue to rise in the US and momentum investors get behind the value story. What this has, bringing this back to the first slide, sorry, I digress slightly, is that while tech was looking very frothy beginning of the year, the first 3 months of 2021 have seen a lot of that froth come out because of the switch into value. So I expect to see some volatility there as US interest rates continue to rise. Tech's probably not going to rally as hard as it has in the past. We have a small overweight to that sector at the moment. We do think that it will continue to be choppy, but long term, we do like FANG and Fourth Industrial Revolution, our two tech overweights. And we are looking to launch a third ETF, which focuses solely on autonomous tech. But I'll talk more about that later. So the first quarter has all been about price moves, moving out of growth, tech in particular, healthcare not as much, into value. We will see a little bit more of that continue over the next couple of months. And so although we do like our tech overweights for the long-term investments, in the short term, we have got value neutralizing that style position to make sure that we benefit from the rotation from growth into value. As I said, that's worked very well for our funds over the last 4 months. Value has doubled the performance of the market, but we continue to hold on to that. So onto the vaccine. And it remains one of the key drivers of the markets and one of the key risks to the markets. And although we're looking past lockdown and new waves and focusing on the vaccine, and although the vaccine is being rapidly deployed, because there aren't enough vaccines, we're starting to see vaccine wars develop. It's a whole new geopolitical risk that we haven't had in the past. But here we've got European Commission President Ursula von der Leyen, who's issued a veiled threat at the UK and saying that they are not, the EU is going to not allow exports of the AstraZeneca vaccine from Belgium into the UK unless they receive their fair allocation of that vaccine. And even within the EU, member states and countries are fighting over the allocation that they get. And the EU has fallen quite far behind the US and the UK when it comes to the vaccination rates. And as a result, there's a lot of infighting now, pointing fingers at the UK, pointing fingers at each other, and all sorts of new tensions arising as they fall behind in the vaccine deployment. And we have seen a third wave emerge. And the chart here shows, you can see that at the very beginning, there's Italy, new cases in the first wave, in the peak over December, January with the second wave, and now March, late Feb, there's a third wave which has started in Eastern Europe and has moved towards Central Europe, including Germany and Italy. And as a result, the old normal stocks like oil crashed quite heavily towards the end of March. Oil fell from above $70 a barrel to below $60 a barrel on the news that there would be quite harsh shutdowns within Germany and Central and Eastern Europe. But as a whole, markets continued to rally. There was just a bit of a switch out of sort of the old normal into the new normal stocks as a result of that third wave. The market's certainly seeing this as a fringe driver of returns, not a primary driver of returns, as the vaccines are rapidly deployed. Looking within South Africa, once again, our vaccine deployment hasn't been as strong as we were hoping. Just before the long weekend, South Africa had vaccinated 260,000 people, or 0.4% of the population, quite far below where the rest of the world is. The US will be at 70% in 4 months. The US is already at 30%, as is the UK and Israel. And some of the science coming out now is pointing to the fact that although you need to get to 70% to move into freely open economy, you only need to get to 30% for the curve to flatten. So that's very important, because it means that to avoid hospitals being overburdened. I mean, the whole reason for lockdowns was trying to flatten the curve, and now just getting to 30% seems to achieve that level. Unfortunately, there are only a couple of countries who have achieved that: US, UK, Israel, as I mentioned. A couple are quite close to that, but South Africa has got a long way to go at 0.4%. Unfortunately, there has been some positive news coming out that more vaccines are on the way, but as South Africans know to not believe promises and trust when things actually happen. But overall, although the vaccine deployment is being used as a relative value or relative performance indicator for different regions, overall it's not leading to markets collapsing or not driving markets to new highs, and certainly it has become a secondary driver of performance in the first quarter of 2021. The primary driver of performance has been all about stimulus. And here, when it comes to stimulus, it's back to Biden. So not only did Biden get his $1.9 trillion stimulus package passed, on top of Trump's already $900 billion, which together make up 13% of the US GDP, but now he's moving on to his legacy, his next big project. And it's amazing that he's only been in the White House for a few months, and he's already $1.9 trillion stimulus package under the belt and done, and already focusing, and has proposed and presented his second plan to the US. So now it's Build Back Better, $2.25 trillion infrastructure project, the biggest since the 1960s space program, focusing on roads and rails and railways and hospitals, and raising infrastructure standards of the US. And those numbers are phenomenal. I mean, if you look at the total current infrastructure balance sheet in the US, it's about $6 trillion. So we're looking at nearly 40% of what's already in the base being rolled out over the next few years. It's just a huge, huge number. And Biden seeing this as his legacy. So he wants the US in 50 years' time to look back and say that this was the moment that America won the future. This is the moment that they moved ahead of the rest of the world and cemented the US exceptionalism. So not in the same way that Trump was putting America first, but certainly hoping that this will raise the living standards and the bar of the US. And if you compare it to the last big rollout, so the 1960s space program, I mean, that was phenomenal. And for a Star Wars and Star Trek fan, I'm quite sad we haven't got another space program being rolled out, but certainly a much better use of, if not less exciting, a much more equitable and better use of assets, rolling out $2 trillion to make the country a better place, to lay the groundwork and platform for future economic growth. And the market's been very excited about this. So I mean, we're talking over $4 trillion between the two stimulus programs. Very good for US GDP, very good for growth, very good for markets around the world. Everyone very excited. Markets rallying to new highs. The S&P breaking above 4,000. But as I've said many, many times in the past, and why we still firmly believe in our Japanification roadmap, all stimulus is just stealing from the future and propping up the present. So Trump, at the same time that he's proposing his $2.2 trillion infrastructure program, is also talking about how he's going to fully finance that through raising taxes. So we're looking at the first major US federal tax hike since 1993. Part of that is repealing portions of President Trump's 2017 tax laws. A major portion is raising the corporate tax rate from 21% to 28%. Focus on raising taxes for high net worth individuals. And as you can see, looking at the chart there, which shows taxes in the US over the last 100 years, US tax rates are low by historical standards, and there is scope for them to be increased quite significantly. But what that means to investors is that when you know taxes are going to go up, you're going to save more, and you're not going to spend as much. So it has the reverse impact. At one hand, the government's trying to encourage spending through rolling out infrastructure plan, but people and investors realize that it just means at some point in the future, taxes will go higher. You're going to get less from your pension fund, less from your savings, and so you're going to have to save more. And at the same time, a lot of people's net worth is in the stock market. So the moment you increase tax rates on companies from 21% to 28%, wipes out a good portion of your future earnings. So all of a sudden, your future earnings have to fall, and that means that the present value of your earnings are lower, and so the stock market has to adjust downwards. Now that hasn't happened yet, so S&P reaching new highs, but at some point the market will go, okay, we need to factor in the fact that taxes are going up, and we've got to pay for this infrastructure program in the future. That means low earnings for our pension fund. So let's save more, let's spend less. And so there's unfortunately no panacea to low growth, because you can only move money around by time. Spend it now, spend it in the future, but investors can see through that. Certainly not the cash that was paid out in the $1,600 that was paid out in Biden's infrastructure program. That just got spent. And that also needs to be paid for in the future. And I don't know if a lot of that went to good uses. At least infrastructure is something that will pay back in the future, and you'll get the return on your assets. But either way, there's a lot of stimulus right now. Markets are quite excited, but they will soon digest that. That needs to be paid back in the future. So we're starting to move into a world that's a bit more balanced. A lot of the good news is in the price. The US is now talking about raising raising tax rates. Vaccine deployment is happening rapidly, but there are vaccine wars in line. The last really strong bullish pillar we have is China. And even China is starting to slow down on its fixed asset investment. So China unveiled its 14th five-year plan in March, and there was a lot of focus on the tech sector. So starting in 2011, so 10 years ago, so the five-year plan that came out in 2011, China realized that they couldn't rely on fixed assets investment, on infrastructure that they'd done for the whole of the 2000s to drive growth massively. And the 2000s growth was just awe-inspiring. Commodity prices were driven. We had a bull market in commodities. All emerging markets did well. Those of us invested or managing money through 2000s remember just how strong commodities were, how strong resources were, just how strong emerging markets were, how strong the rand was. It really was an amazing time. But in 2011, after the crash, the great financial crisis, China realized it was time to start focusing on the new economy. And so they began a plan where they started to shift away from materials, commodities, and shift away from building roads and bridges and hospitals, and trying to prop up or drive Chinese domestic consumption. So shift their share of GDP that was focused on the primary and secondary sectors, move it more to the tertiary sector. So the US is leading the way, the world there with very, very strong services. Services are certainly the strongest sector within the US. China in 2011 was all about the primary and secondary sectors. So they started this focus on the new economy. And that did quite well. It got delayed a bit by Trump's focus on trade wars, and then got again delayed last year by COVID. But this year, the first quarter of 2021, it seems to be back on track. So if you look at China's imports for the first quarter of 2021, 22% increase. But what was very interesting about that is looking within that 22% and seeing the slowdown in demand for iron ore and crude, and the acceleration of imports of high-tech parts. So going back to their 14th five-year plan, in the next stage of the China new economy, not only now are they shifting focus away from fixed asset investment from the primary and secondary sectors and onto the tertiary sector, services and domestic consumption, but for the first time, the 14th five-year plan had a section dedicated exclusively to tech development. So the plan lays out 7 technology areas of focus, including artificial intelligence, quantum computing, semiconductors, and space. And Premier Li says that China wants to increase their R&D spend by more than 7% over the next 5 years in pursuit of major technology breakthroughs. So certainly when it comes to the war between US and China, as we've seen Trump's concerns over the last year or two, it's all about the tech space. And we certainly think we'll see a lot more support of that sector from China as they move now past, well, as part of the new economy focus into the tech and trying to drive their own innovation. Innovation being the key now that all countries in the world want to focus on. The US has been exceptional in that over the last decade. Silicon Valley and the tech sectors there, the FANG stocks, have been phenomenal performers and have gained massive market share. But Europe and China, they want to try and claw back some of that, and so they're focusing on innovation as well. And we do think that this is very positive for China, although it will slow down the overall growth. So part of their 5-year plan was admitting that growth will slow and that there will be a slowdown in commodity imports. And that's why we don't see another super cycle for commodities anytime soon. In fact, we do think that commodities have peaked or will peak in the second quarter or third quarter of this year as China focuses on rebalancing its economy and looking at tech in particular. And part of that is reining in the tech sector that has been so rampant in China. So in particular, we've had Baidu and Alibaba and Tencent. Naspers owns a good chunk of Tencent, have done phenomenally well and left the rest of China, the technology sectors behind it in the dust. And so the government feels that these companies have just strayed a bit too far from their reach. And so they're clawing back. And we are now seeing a lot more regulatory focus on those stocks in particular. So there have been some fines recently. We had Tencent's earnings come out in March, double, the earnings were double what was expected, but the stock fell because at the same time, the regulator said, no. We need to expand our reach and make sure that there's nothing funny happening within these big tech stocks. So already, not only have fines been rolled out, but Alibaba has been asked to dispose of its media assets as a result of antitrust investigations. And at the same time, Alibaba is planning to offer some of its services on its rivals Tencent's platform to try and appease the regulators. So we do expect a little bit of a slowdown in growth of the large caps within China from the tech side, but the smaller caps should certainly do really well as there's a focus on growing the entire tech sector within China. So it's interesting now that we get to April. Performance has been phenomenal over the last 6 months in the stock markets around the world. We're getting to that seasonal time of sell in May and go away. And we're starting to see more balanced drivers come through from our various pillars. Before it was just all positive story on the stimulus, positive story on the vaccine rollout, positive story on China's growth. And now there's a more balanced story coming through with the US talking about raising taxes, China talking about slowing down its stimulus and focusing more on the tech, and vaccines more focused now on the risks that arise, like blood clotting with the AstraZeneca virus, or fighting about who gets what and when. And so a bit of a balancing story coming through, and that might time quite well with the negative seasonals that we do see in markets in the middle half of the year. So we're not getting bearish just yet, but it's certainly something to worry about as we move into April. So when it comes to South Africa, as I mentioned before, we remain underweight South Africa equities, overweight global equities. And it's primarily because we're looking for a catalyst within South African growth. Equity is very linked to growth. And the biggest catalyst is Eskom. We need stable electricity consumption and production to allow stable and strong growth. And we got very excited about the State of the Nation address. Cyril's focus on stable electricity production was very strong. He mentioned a number of things, including in particular, reducing the amount of red tape and bureaucracy around self-generation of electricity, and raising the cap on self-generation from 1 megawatt. So at the same time that happened, well, a few weeks afterwards, we had in the midst of stage 2 and at one point stage 3 load shedding that happened in March, we had Andre de Ruyter, the Eskom CEO, come out to support what Cyril was saying, yes, this is the right thing to do. We need to lift the cap on licensing of renewable energy self-generation from 1 megawatt to 50 megawatts. Makes sense. And at the same time, Eskom, on the 1st of April, increased its electricity tariffs 15.6%. It was such a big increase, actually, I was worried that it was an April Fool's joke. I had to go and just make sure that it was the real thing. So Eskom is struggling. And one of the quick wins, as pointed out at the State of the Nation address, was to raise, just remove the bureaucracy. So, and the Eskom CEO came out to support that. And unfortunately, what happened is well, I suppose fortunately, in some stages, at least we had Gwede Mantashe announce the preferred bidders to provide emergency power for South Africa. 8 bidders, which provide a total of 1.8 thousand megawatts from various technologies. But when Andre de Ruyter came out to say, listen, let's focus on reducing the bureaucracy and the regulations, and let's try and encourage renewables. Gwede Mantashe told Andre de Ruyter that Eskom must stay in its lane. And instead, the focus right now is not on improving regulation, but on locking South Africa into expensive, polluting, and foreign-owned solutions, which is rather concerning. When we look at the 8 projects that have been approved for this emergency power, 3 of them belong to Turkish car power ship, which installs floating power stations off Kucha and Saldanha in Richards Bay, and they will use liquid natural gas to produce power. So that's foreign-owned, dirty energy that is being used to support the power grid. Now, it is desperately needed. So we need to avoid load shedding, and so I applaud the fact that we at least have got to this point. But we need to look at the full solution. We need to reduce the bureaucracy. We need to look at cutting the red tape. And I was disappointed that even though it was mentioned in the State of the Nation address, we have not allowed that easing of local renewable self-power generation happening. One of the other projects is Aqua, which is a Saudi-owned company. And despite that, Gwede Mantashe promises that of the 8 bidders, 41% is BEE owned. So I'm not quite sure how that works, how when a foreign company sails its ship into South Africa waters and parks offshore, how South Africa BEE companies benefit from that, but we'll have to wait and see. But anyway, as you can see from the chart there shows South African GDP in the light green light and South African energy consumption in the dark green light, very closely tied. We definitely need this catalyst to happen. And there's all sorts of, Eskom is just fraught with issues. It's not only the massive amount of debt and our regulations that aren't being helped, but nearly 4,000 of Eskom's 44,000 employees face disciplinary proceedings. And now I see there's a further dispute with their software provider, Oracle, that was announced today. So it just seems to be issue after issue after issue. On the other hand, what was quite promising is that there was an announcement that will start the procurement process for 2,600 megawatts for private power producers, also renewables that will be launched locally. And that is quite exciting because that's what will filter into the pension fund infrastructure program. And we are very excited about those prospects. So the end of March was the deadline for Reg 28 submissions, and Sygnia did provide our response to that regulations, and hopefully the National Treasury will listen to what we've said. So what was interesting about Regulation 28 is that there's been a lot of focus on increasing the amount of private equity. So the limits on private equity was raised. Private equity was spun out from hedge funds as from an alternative framework, and you can now invest a decent chunk of your fund into private equity. But what is interesting is that when you look at how infrastructure projects are financed, it's roughly 15% equity, 85% debt. So now we've increased the limit on private equity, but we haven't increased the limit on private debt. Private debt is limited to 5%. Private equity is now 15%. So we certainly, that was the one thing that we asked for is, given the spread and the huge amount of private debt financing that's required for these infrastructure projects, please can we increase the amount of private debt? So hopefully National Treasury will listen to our comments and we'll see what happens there. So let's look at positioning. Last month, I spoke about Japanification and the fact that we still believe in a low growth world, despite the fact the market's up 30% over the last 3-4 months. And so we still believe in our alternative satellites, which look for uncorrelated growth in a low growth world. At the same time, you need a passive core to keep costs down that is liquid. And then we have our ESG framework that overlooks the whole process, and our TAA overlay, which looks at risk across the various sectors. So looking at our satellites one by one, starting at the right here, we've got our tech satellite. There are 2 funds there, the 4th Industrial Revolution Fund and the FANG Plus Global Equity Fund. Both of those phenomenal long-term growth prospects, where we've got very small overweights to that right now, just because we are expecting a lot of volatility. Fortunately, those over the first quarter, they have underperformed relative to the market, so they're not looking as frothy as they were. But we have got our value investments balancing that over the next couple of months. So we are waiting for a better entry point to top that up, but we do believe that it's a great place to be for the long term. So long-term investors, we recommend against selling, but we're waiting a little bit longer before we top that up going forward. Our second alternative growth satellite is emerging markets, particularly Asia emerging markets. So we are launching our EM50 ETF That is expected on the 3rd of May. So please put it into your diaries. We're still waiting for final approval from the JSE, but right now, estimated date is 3rd of May for the EM Emerging Markets 50 ETF. And 85% of that ETF is Asia emerging markets, China and the surrounding areas. But we are quite excited about China, particularly China new economy and China tech that I've spoke about. And so we will also be launching a China unit trust and China ETF. We started that process, but that's probably only going to be launched towards the end of this year because it takes a long time to set up those accounts. And as investors will know, unlike our competitors in South Africa who only invest in feeder funds, which then hold BlackRock, we invest directly into the underlying shares. This allows us to give much smaller bid-offer spreads on our ETFs and much lower TERs and much lower costs. And as a result, over the long term, we firmly believe that our funds will outperform because of the lower costs. Unfortunately, it does take longer to set up those accounts because you don't need just one account in the UK buying a BlackRock feeder. You need to set up accounts in all the underlying markets, and there are many underlying markets. The third satellite is healthcare. And we believe that there's very strong tailwinds to healthcare over the next decade, aging populations, rising income for those populations. So not only are they living longer, but they can afford to spend more on healthcare, which will drive the healthcare sector. Our unit trust has been launched for 6 months now, and the performance of that hasn't been as good as the market. And so we have got quite a large overweight there. We do think that will do quite well in the short to medium term. And the good news is that our ETF is expected to launch on the July, mid-July. So we're getting closer and closer to that point for the healthcare ETF. And that will certainly be a great entry point for that sector. We also have the OSI fund within that satellite, which is unfortunately closed to new business. But we do have exposure to OSI within our Health Innovation Unit Trust. We've also got genomics exposure within our Health Innovation Unit Trust, and we are increasing our genomics exposure because we think that's a very exciting place to be going forward. Our fourth satellite is unlisted credit on the local side, and infrastructure on the local side. We are making our first investment into infrastructure this month, and we'll be launching the fund relatively soon thereafter for our institutional clients. We are very excited about that space, but we are waiting for Regulation 28 to be finalized before we can do anything on a large scale and roll out a separate fund. The fifth satellite is our specialist real estate ETF. That is a nice place to be. We also have a very large overweight because it is more of a value focus and a growth focus. So it balances the growth of health and tech. And it's also specialist real estate. So it's got some defensive sectors like cell phone towers and hospitals that aren't as exposed to the COVID sectors. So it's relatively defensive, and it is correlated to value. So we do like that as a balancing style ETF. Looking within our core, we are overweight global equity, as I've mentioned before, and coming shortly on the 12th of April, we will be launching on our newest ETF, which is the S&P 1200 Global ESG ETF. So that's an awesome ETF. Not only is it priced incredibly cheaply, but it gives you exposure to the world, S&P 1200, which includes emerging markets. So it's a nice broad exposure. It's got a smaller allocation to the US because it has exposure to emerging markets, and it has an ESG overlay. So it gives you a really nice, if you're looking for passive, diversified, liquid, it's got everything. It's got emerging markets, it's got developed markets, it's got ESG, it's low cost. It really is a great place to invest for the long term. If you want a one-stop shop, that's your best place for equity, global equity investments. in terms of well diversified. And so please look out for that on the 12th of April. And the other exciting news we have is we'll be listing all our ETFs on a secondary listing on the A2X exchange. That happens on the 14th of April, so look out for that. So now not only will we be able to invest in our ETFs through the JSE, but you'll also be able to invest in our ETFs through A2X. So please keep a lookout for that. So just a summary of the dates. The first one, April 12th, is our global ESG. Then April 14th is the secondary listing of all our funds on A2X. Then 3rd of May is the EM50 ETF. Healthcare ETF is expected end of July, and then China towards the end of the year. And then we've also got a couple of other ones that we've spoken about in the past, like crypto and autonomous tech. Those are both still in the design phase. We're not quite sure exactly when those will be launched, but autonomous tech should hopefully be quite soon, whereas crypto is very much dependent on the JSE, so I'm not quite sure exactly when that's going to happen. And then just a summary of the core and where we are on our passive holdings. We remain underweight SA equities because we're still waiting for that catalyst. Yes, there was some exciting news around Eskom, the State of the Nation address. Yes, we have had the emergency power preferred bidders announced, but we haven't seen an improvement in the regulations, and there's a lot that's of concern at Eskom. Load shedding is still happening in full force. So until we get more comfort that Eskom can be fixed, we remain underweight SA equities. And just to put it in context, you may think it's odd, and certainly SA equities is one of our largest exposures, even though we are underweight. But on the global scale, the entire Johannesburg Stock Exchange is smaller than Apple or Amazon. So that's why we believe in, one of the reasons why we believe in passive is if you are going to expend research energy, rather expend it on global themes. We call it passive stock selection, but you find the themes that will do well over the next decade and stick to those themes allows passive stock selection. So you get growth, but at a low cost. Locally, we're happy to stick to index weights. Well, investing in indices. You don't have exposure to the same exciting growth themes locally, and really, one global stock's bigger than our entire stock market. So you almost wonder why you bother with a team of 20 equity analysts deciding whether you want to be overweight Truworths or underweight Sygnia. Rather keep your allocation low cost, get the beta when the market does rise, but focus. Use your research budget to focus on what global themes are going to outperform over the long term. South African bonds, we remain overweight. That's very much a value call, is because the yield there is amongst the highest in the world. Yield curve is very steep, and we do think that offers value. Global equities, we are overweight. Global bonds, we remain underweight. So as I said before, global bonds are very much linked to quantitative easing. Quantitative easing is distorting global bonds, global or gold, Bitcoin, anything that's linked to your risk-free global rates. Anything that's distorted by quantitative easing, we are staying clear of. So QE is still happening this year. Over $4 trillion of developed market bonds are being bought. Now, we're not even talking about selling bonds. We're talking about just buying less this year. And when we get to a point where we stop buying, and when growth allows it, probably towards the end of this year, and yields rise, it's going to have a terrible impact on global bonds and gold. And we've seen that. I mean, over the first quarter of this year, some of the worst performing sectors are developed market bonds and gold. And we think that will continue as the year rolls out. But the surprising factor there has been Bitcoin. You would think that Bitcoin, being a proxy for gold and a proxy for developed market bonds, would have hit some headwinds, but it hasn't. There's been idiosyncratic demand benefits like Tesla buying, which has given a lot of people confidence. And we'll see what happens. But I'm also very watching with focus on Tesla. We've got Mercedes unveiling their EV in April. They have already declared that it is going to be faster than the Tesla vehicle, with a longer range and a better acceleration. So when the big guys start to really focus on R&D, we could have some very interesting EV vehicles that come out and could lead to some market share strains on Tesla. And once momentum comes out of that stock, well, then it's going to have a very, very quick turnaround, which could then impact if they're forced to sell Bitcoin. We'll see. There could be some unwindings of some rather extreme valuations. But right now, those continue to go up, and we certainly are not brave enough to short any of those, the Bitcoin or Teslas. But we don't own global bonds, and we don't own gold in our portfolios. Possibly in a year or two, when interest rates have normalized, QE has stopped, and global bond yields are a lot higher and gold prices a lot lower, we may change our view. Okay, I see we have 10 minutes. Sorry, I thought there'd be more time for questions. Try to keep it fast. And let's go through the Q&A. Yes, EM ETF will be launched. I have spoken about the dates on that. The skeleton balanced funds. So that is the institutional survey that I show. Louise is asking for the retail surveys. That's a very, very good idea. We do have those slides. We do have the comparison. I can include that going forward. The skeleton balanced funds on the retail side are looking phenomenal, absolutely phenomenal. I'm very proud of those performance. I think skeleton balance 70 is probably 10th out of 80 funds since inception. Skeleton balance 60, I think, is first or second out of 70 funds since inception. And skeleton balance 40 is also first or second out of, again, 70 or 80 funds since inception. I don't have the exact numbers on hand, but much bigger universe when you compare against not just the big guys, not just the top 10 managers, you include all the other asset managers, performance looking phenomenal. Number 1 or 2 on the lower risk funds, top decile on the high risk fund, certainly showing that low cost funds are outperforming. And we're not only outperforming the active funds, we are outperforming other passive funds as well. And I think that is part due to our active asset allocation and risk management overlay. So although we invest in passive equities and passive bonds and passive global, we manage the overall risk and exposure to thematic global ETFs in a dynamic way to ensure that we always have the best expected return for the given level of risk. And yes, to answer Jonathan's question, we do manage around potential over expensive asset classes, and that's why we only have a very small allocation right now to tech and FANG and a large overweight to healthcare and property and emerging markets, because we think that the relative risk adjusted expected returns are different right now, while interest rates in the US are continuing to rise. I do think there'll be extended volatility in the Fourth Industrial Revolution Fund over the next quarter. A lot of the froth has come out. The fund has adjusted. We remain long-term holders, but I think that in the short term, as US interest rates rise, there will be a little bit more volatility in some of the growth sectors. Which funds invest? So all our funds have the same global exposure. So whether you're in the signature range or the skeleton range or the skeleton balanced range, we have exactly the same global exposure. So that includes a strong allocation to passive core, MSCI World and S&P 1200 ESG, and then allocation to the satellites, Fourth Industrial Revolution, FANG, healthcare, property, and that includes at the moment our value ETF. So as I said, we're not going to offer that to retail investors because that's more of a risk mitigating tool, but all our funds that have global exposure currently have exposure to that value ETF, and that has worked really now very well for our balanced portfolios. Yes, I'll pass it on to our marketing team. Given all the American stimulus, what is your view on the US dollar and US exceptionalism? Certainly, like we are hearing rumors of the next super cycle in commodities, and we are now hearing rumors about the next super cycle in the US. I'm less inclined to believe those, just because China is rotating out of infrastructure and into more new economy stocks, and the US is now talking about raising tax. So I think things aren't quite as exceptional as we'd like. Yes, there's a lot of stimulus, but the stimulus is in the bag, so to speak, whereas talking about taxes is the new news that has to be adjusted. And markets are very much focus on discounting new news, and the new news is more negative than positive. So certainly, a stimulus, $4 trillion of stimulus has to help the US. It can't not. But I don't think the dollar is going to run away from us, and I don't think US markets and growth is going to outperform the rest of the world massively, because we are now Biden is focusing on the tax side and making sure that any future stimulus is balanced. I am worried about China. It's clamping down on Tencent, and that will impact Naspers. So our view on Naspers is mixed. We remain overweight the Swix versus the Cap Swix because Naspers trades at a massive discount to Tencent. There's at least a 50% discount. And there are a lot of reasons for that, CGT and being locked in. But whenever there's bad news that comes out on the antitrust regulatory side for Tencent, Naspers doesn't do as badly because the discount narrows. And then when Tencent starts to rise, well, then the discount opens up again. So you need to balance the discount to Tencent against the bad news. So for the moment, we remain invested in the Swix, which has got a lot of Naspers, but we are cognizant of that risk, and we do have protection on Naspers. So again, all our balanced funds that have exposure to SA equities also have a Naspers hedge in to protect against any terrible bad news that might come out. Yes, concerned about the fact that yields will continue to rise in developed markets bonds, whereas South African bonds, which have been hurt to some extent by developed market bond yields rising, I think there's a lot more safety margin in SA bonds. Now, resources, we don't take a view on sectors within South Africa, but I do think that a lot of the performance is well, let me look at it this way. So resources are looking very cheap on a PE basis. Historically, though, whenever resource stocks look cheap on a PE basis, it was time to sell. But what drives it more is the underlying commodity prices. They're continuing to rally, so it's probably too soon to call the top on resources, but I definitely think that China slowdown towards the second half of this year will put a dampener on resource prices. In terms of living annuities, we are working on our limit. We're working on that quite closely. We're hoping to have some good news out on that shortly. We'll see what our numbers are like at the end of March. We are definitely trying to get that back below 40%. It's just rolling through here to see more questions on living annuities, commodities. That's getting balanced. Yeah, here's a thought. There's a question about nanotech batteries. And I have had this question a couple of times. So a lot of people are saying some oil is going to run out. So we have to invest in electric vehicles. Now, yes, electric vehicles are the future. And we certainly are going to be launching an autonomous tech fund, but it's going to look much broader than that. It's going to have a climate change focus, and it's going to look at sustainable investing in all the way that will be. So more renewables than just electric vehicles, and sustainable food production, sustainable transport. And my concern with just looking purely at, there was some questions about should we start a nanotech battery ETF or a lithium ETF. My concern is that I remember back to the late 2000s. And back then, a similar wave was arising. People were saying, oil is going to run out. At that time, oil was quite expensive. It was over $100 the barrel. And the banks were predicting it was going to go to $200 a barrel. And everyone was concerned about that oil was going to run out, and we need to focus on the new driver of energy, and that's going to be nuclear. So at the time, there was a massive drive into uranium, and the uranium price shot up massively, and then collapsed. And I'm just worried that we are starting to see in certain sectors, when it comes to ESG, climate change, some of the innovation stuff, a very strong focus on things that where the trend is not going to last forever. Yes, electric vehicles are the future. Yes, renewables are the future. But I think it's better if we have a much broader view of that trend. And let's not just focus purely on owning Tesla. And I think that's one of the big drivers of Tesla in itself, is that every ESG equity fund out there has 10% allocation to Tesla. Now, Tesla itself is not a great company from an ESG perspective. When you've got electric vehicles that are plugging into networks that are driven by coal power stations, it's not beneficial. Plus, there's a lot of pollution that happens in terms of batteries and disposing of batteries. So while we are firm believers in renewables and firm believers in ESG, I think let's avoid focusing on very specifics like nanotech and batteries and lithium, and just like, because I think that's going to get hurt like uranium was 15 years ago. But I could be wrong. Let's see what happens. Question on my performance fees. That was just an adjustment to bring in line with the industry. Bond funds locally are doing quite poorly because the South African bond yields have risen again, and that is just because of US developed market yields that have risen. And South African bonds are comprised of a number of things. Starts off with US interest rates, and then you add on South Africa risk premium and South African inflation, and rising US interest rates have led to a better entry point into South African bonds. And when South African bonds got down close to 9%, we did move that allocation to neutral, and now we've gone back to overweight now that the value has risen. And again, if you're invested in any of our balance funds, you benefit from that TAA risk process. And when bonds are looking a bit more expensive, we lock in those profits. And when there's a bit more value, we open up that position, and that's what we have done. So bonds are looking good right now. The difference between the Sygnia All Bond Index Fund and Sygnia Enhanced Index Bond Fund is the Enhanced Fund has access to credit, and the other one doesn't. So over the long term, credit should outperform the actual index, but credit does introduce a bit more volatility. So it all depends on your risk appetite. If you've got a bit more appetite, a bit more risk, you can expect a bit more return and go into the Enhanced Bond Fund. Nothing, unfortunately, from the SARB on having more than 30% offshore in our retirement annuities. We're hoping for some news, but that has not materialized. We are continuing to ask them, and we are staying engaged. A question that has arisen a couple of times. It all depends on what assumptions you use. And the question here is by Matt. He wants to know, should I be invested in Reg 28 funds where I get a tax benefit, but I'm limited to 75% equities, or should I go direct? And so it depends on your assumptions. Certainly, the old assumptions that we had for the 80s and the 90s and the 2000s, when equities are giving you inflation plus 10, well, then it makes more sense to be invested directly into equity portfolio and not get the tax benefit. But the new normal, when we're expecting equities to be inflation plus 5, well, then the tax benefit becomes far more important. So yes, it depends on the tax, on your estimates for your returns. But we think, given our expectations of various returns, that the tax benefits of being invested in a retirement annuity outweigh the constraints on your asset allocation within that. OSI is our Oxford Science Innovation Fund. Unfortunately, that is closed. We need to get our life assets below 40% so we can reopen that. And A2X is an alternative exchange. It's a competitor to the Johannesburg Stock Exchange. There's a good question from an investor who wants to know the balance between core and satellite. So on the global side, and that we try and do it in a balanced manner for all our balanced funds. So you can invest directly into the Sygnia Skeleton International Equity Fund of Funds, where we manage that balance between core, passive, and satellites. But if you want to go directly into those satellites and directly into the ETFs and make your own blend, well, it very much depends on your risk profile. So if you have a low risk profile, then but you're a long-term investor, then you probably want to invest more in the diversified, liquid, low-cost MSCI World or S&P 1200 Global ESG. And then the more risk you want to take on to achieve higher returns, then you can put more into the satellites, tech and healthcare and the likes. But that doesn't increase the volatility. So it really does depend on your risk appetite in terms of how much additional risk you want to take on, how much additional volatility you prepare to stomach to be able to achieve those additional returns. Because as we have seen, not now, but a year ago, over 7 years, equities are underperforming bonds. So that you do get times where your higher expected return asset classes underperform your lower return expected return asset classes. So it is very much your long-term time horizon and your ability to stomach the extra risk. Question on the Rand, which is always impossible, but we do think that barring concerns about inflation getting out of control, which leads to jerky increases in the US Treasuries, that the Rand will stay quite strong this year. We think it will average around 15. We'll be dropping down to 14.5 and we'll be getting as high as 16. But we think that there's, while the rest of the world is growing, there's more upside to that. There's less downside to the Rand. But the Rand is linked to risk on, risk off. So if we do see that your typical seasonal balances of sell in May and go away, the Rand could get a bit weaker towards the middle of the year before recovering towards the end of the year. And then just a last quick question on local equities. As I said before, local equities have a lot of value. They are the cheapest they've been in 100 years. And that means basically since as long as we have data. So if you have the stomach to get stuck in a value trap, then you certainly can start investing in local equities. We have reduced our underweight. We have a very small underweight to local equities. We're only underweight 1%. But we are waiting for a catalyst before we go overweight, because what it means is it's reducing the balancing factor of selling out of global equities to fund the local equities. And right now, there's just a lot more exciting growth opportunities globally than there are locally. And the other factor that I didn't mention is that developed markets are certainly getting COVID under wraps a lot quicker with the rapid vaccine rollout. Not just that, but China and some of the emerging market Asian countries, and Europe and the UK and the US and Japan, all having solid strategies in place. So whereas South Africa, with only 0.4% of our population inoculated, well, that's also going to cause us to lag global markets a bit. So on the one hand, you've got intense amounts of value, South Africa looking very cheap, but then on the other hand, you've got concerns about growth of Eskom and slow rollout of vaccines. The experts are often wrong, expecting a third wave in South Africa towards the end of April, which could see a third lockdown. So, we're just waiting for a better opportunity to go overweight South African equities ourselves. Yes, a number of our peers have gone overweight. We prefer keeping our overweights and our equities to our global themes, emerging markets and healthcare and FANG and fourth RX, etc. So that's it for this month. Sure, I can't believe it's been a year since our first lockdown and our first Zoom webinar. So thank you very much for everyone who's tuned in. Thank you for sticking with me for a year. I hope these continue to be valuable and interesting, and please do send through comments or questions. I do get a number of people asking for me to focus on specific things each month, and I do try and meet those needs. So please do continue to do so. Have a fantastic April, and I'll see you beginning of May. Cheers.